Steve, let's talk about silver. We got a lot of a lot of interesting things happening. We've seen it actually come up some here, but I think the question is, why is the silver price going to surge when the manipulation ends, and will the manipulation end?
Yes, Kenneth, the precious metals will surge, and as I have spoken to you before in the past, my analysis on the rise of the value of the precious metals, physical gold and silver, will happen as we get this ongoing collapse of the markets, and that's based on the energy. And so when we start to see the markets really crack, the Dow Jones Industrial Average fell almost 50% from 2000, its peak in 2007 to its bottom in 2009. Well, now we're at 20,000, almost 20,800. So to get back to that same level for a correction, we'd have to lose more than 50%. A 50% decline would be down to 10,000. So at that point in time, when we see this massive correction, and it's coming, it's coming, and the longer it's propped up, the worse it will be. But this is when we're going to see the actual metals price increase as the stock market crashes, and we can get into the reasons why my analysis sees that.
Sure. Well, I recently had a guest on the line, and his name is Charles Savoy, and he talked about silver and the fact that, not the fact, but the possibility that the U.S. could nationalize silver at $2 an ounce to build a strategic military stockpile. And I want to get your thoughts on this, and maybe you can shed some light on this for people who might be concerned.
Okay, Kenneth, before I get into that, I published a lot of Charles Savoy work from silverstealers.net. He does an excellent job researching who's who in what he calls the Pilgrim Society of the elite that have been controlling, let's say, the precious metals, especially silver, for hundreds of years. So his work is fascinating. He goes into all this in-depth research showing who's who and how it connects to everybody else and bringing it forward to today. The thing is, I got several emails after your interview with him from several of my readers saying, did you see this, that they're going to nationalize the price, that they could nationalize silver for $2? And I think Charles said that you don't have to pay capital gains. Well, the thing is, at $2, there is no capital gains. Because that's a silly thing to say, because most people have been buying silver, between $10 and $40 an ounce. So at $2, you're getting a loss. So you do want the capital gains loss on your taxes.
Of course.
But anyhow, during the 1934 Silver Purchase Act, it was passed by Congress in June 19th, and then Roosevelt actually passed it on August 9th. Now, the reason why they did that, and there's several reasons I won't get into, but the thinking behind that was to acquire more silver to back the gold to silver monetary ratio 4-to-1. So they needed to acquire a lot more silver. Now, this is what's interesting. When the passage of that act in the beginning of 1934, the price of silver the market price was 44 cents an ounce. By the time the bill was passed, the Silver Purchase Act was passed on August 9th, 1934, it had increased to 49 cents. And the U.S. government, the Treasury, was paying people 50 cents to buy their silver. So they didn't have to pay a lot less. They were paying actually for silver above the market price. So I find it very difficult that the U.S. government, if they're going to nationalize silver, which I doubt they would, they're not going to pay $2. the break-even cost for the primary mining industry, Kenneth, is anywhere between 15 to 18, average 16, 17. So to me, at worst case scenario, they're going to pay market price, probably above market price. Now, so I wanted to say that also during the whole time, during the Silver Purchase Act from 1934 to 1938, the U.S. government only acquired through the Americans 113 million ounces. That was it. They actually needed to get 1.24 billion ounces of silver to get this 4-to-1 gold-silver monetary ratio. So where did they get the 90% of the silver? It came from foreign countries like China, Mexico, India, to name a few. Now, there's a lot more reasons behind that, but I wanted to let you know, your readers know, that the nationalization of silver during the Purchase Act of 1934 wasn't to confiscate silver from Americans for a deviant reason. It was to build our gold to silver monetary stocks, and we only acquired 10% of that amount from Americans. So in the future, even if they're going to have a nationalization, and I'll end it with here, if they're going to nationalize silver, why go door to door? Why do that? They had to do that years ago because that's where the silver was. Why not go into the silver ETF? Maybe not all the silver's there, but according to the silver SLV ETF, there's 330 million ounces there. Why spend all this time going after all the silver that's all over the country, and maybe it's in bookshelves, it's in safes? Why do that when you can go to a couple vaults and get the silver if the military needs it? And let me end by saying this: the military, or let's say U.S. industrial silver consumption in 2015 was 127 million ounces. That's it. All of our industrial silver. Now, if 10% was used for military, that's about 13 million ounces. But I think it's much less than that. Even at 13 million ounces, how much do they really need to acquire to build up their stockpile? 50 million? I mean, that's easily made by going into the silver ETF inventories. So I really think the nationalization is a non-issue. It's scare. People get worried about the nationalization. I don't see that as a big threat in the future. So I wanted to also add that information.
Sure. Well, it's good perspective. I know there's people passionate on both sides of that. But it's interesting that you say that $2 an ounce is out of the question. We know that the Federal Reserve, took everyone's gold at 20, and revalued at 35. There was this big loss of purchasing power that people saw back then. Why wouldn't they do something that's quote unquote deviant and take everyone's silver for $2 an ounce? And I know you brought up the production cost. Why does it matter what the production cost is for silver when the government is just giving you something in exchange for real money?
Well, we could take the defense would be anything is possible. The government can do anything. The government can do anything, but there's some method to the madness. If they are going to acquire land for whatever purposes, the eminent domain, they're not going to pay you 10% of your property value. That's rare. That never happens. They try to give you close to market value or somewhat less than market value. But the problem is, again, I gave you the example. In 1934, the U.S. Treasury paid more than market value. Now, you did bring up a good point. Yes, the Roosevelt confiscated, well, let's say nationalized the Americans' gold, but they paid them market value. They paid them $20. They didn't pay him $2. They paid him 20, and they revalued it to 34. So yes, you missed out the gains. That was a way to inflate the money supply. That was the way the government did that. However, let's say you were smart and you were in the gold miners, like homestake mining. If you lost out the capital gains on that $20 to $35 increase, you surely made it up in owning homestake mining, because you see, they paid homestake mining $35 an ounce for their gold. So the gold mining companies in the United States saw huge profits during this time. So this is the issue. If we look at things in a singular, or let's say when you write a paper or college and you put one source, the teacher's going to look like you're an idiot. So you have to use lots of sources. You have to use lots of different areas to see if your paper, your abstract, or your report makes sense. So if we look at all these different areas, I hardly doubt the U.S. government, if they want to nationalize silver, are going to pay 10% of the market price. It just, to me, it's something that they would not do. Now, they know it's inconvenient from taking it from the public, so why wouldn't they offer market price or above market price? So they get the silver, they're happy. People at least get what they paid for it. They're not happy, but they're not upset. And so that's how I see it happening. Now, will they take the silver and revalue it? I don't know, because the issue that Charles said was due to a military stockpile. And again, my logical view at this is, if they want to nationalize silver, why not go after the silver that's held in the vaults? That's the easiest silver to get. They can send the armored trucks there, they can acquire it, and they can move it to the U.S. Treasury vault or whatever. They don't need to have to go out and spend all this money harassing Americans if the silver's there, which I think some of the silver's there, a good portion of it. So that is how I look at it. Sure. I don't see a nationalization of silver to be less than market value, and I don't see them coming door to door to get it.
Yeah, and totally understandable, and you bring some great perspective to the topic. Another thing Charles talked about was, in America, to make ends meet, both spouses would have to work, and he said that it was due to the Pilgrims controlling the wealth, thus making it harder for the typical American to earn a living wage. And I know you wanted to respond to that. Steve, what is your response to this?
I agree with Charles. And again, my rebuttal or my questions are not to discount his analysis. I think his analysis, I don't know all the details. That's where he spends a lot of his information. And if you listen to his interview or read his papers, you can get lost in all these different names and all these elites and how they're connected to everything else. The elite have been controlling the world since ancient Rome, and even before, during the Egypt Empire. They've been controlling things forever. Nothing's changed. They still control the markets. Now, sometimes they control a larger percentage of the markets. I will give you that. Now, the issue is, the reason why I don't, the real reason, and this is how I differ from Charles, I look at the energy, not just what the manipulation or the control of the elite. You have to look at the energy too. Now, the energy return on investment back in the 50s and 60s was very high. It was above 50 to 1. That means for every barrel of energy cost he got 50 barrels of oil. Now, that allowed the typical family huge, let's say, we were able to do a lot with very little. Thus, a husband could afford to have a home, usually one car, and support the child or any children. So one spouse had to work. Now, as the energy return on investment has continued to fall, now shale is only 5 to 1. If you average everything in the U.S., it might be 8, 9 to 10 to 1. The thing is, we need 20 to 1 or more. So what does that mean? It means the cost of living now is so much higher. And then we add all this technology. We didn't have all this technology back in the 50s and 60s. We didn't have cell phones. We didn't have computers. We didn't have 4 TVs in one house, and all 4 cars now that people own, and an RV. We didn't have a tremendous amount of technology. That costs a lot of money. That costs a lot of energy. So, according to my analysis, yes, the elite control more percentage of the wealth of the world. That's a given. I agree with that. They actually control more than the percentage in the 50s and 60s. That's true. But the overriding reason that the earning wage of the American has declined so much, and we now need 2 people to work to pay bills, the falling energy return on investment, as well as the increased use of technology in our world. And so those are the 2 reasons I see that why Americans have to work 2 jobs. And we know the falling energy return on investment is happening, is destroying the system, because now the pension plans can't even be paid. They can't even continue. We're seeing a lot of trouble. This is where the falling energy return on investment really starts to show first. It shows in the financial assets, especially the ones you pay out to retirees. Those are going to go first. When you start to see huge problems with the pension plans, you're going to see huge problems with the retirement accounts. They'll come soon after the implosion of the pension plan market. So that's the reason why we're seeing falling living wage, is the energy return on investment much higher than the control of the elite.
Steve, you brought up technology, and technology is something that is interesting. It definitely costs more to have more technology, but technology is something that makes things cheaper. I mean, people are wearing things on their wrists now that would have cost hundreds of thousands of dollars 50 years ago, maybe even less than that, or tens of thousands of dollars. I don't know, a supercomputer. Now people are wearing Apple Watches on their wrist. I'm wondering if you think technology over time helps to offset the energy return on investment, because people can live a higher standard of living for more efficiently because of more technology.
That's a good question. And a lot of people when they drive across the Midwest, they go visit family, and they go across the middle of the country on the interstate. And in Iowa or Kansas, they see one tractor, one farmer with a huge combine. And it looks like this one farmer is producing all this food for thousands of people. So he looks really efficient. Looks like technology has made him more efficient, brought the price of food down, and he's able to produce a lot more. Well, let me just say, the hunter-gatherers, when they burned 1 calorie of energy, they produced 10 calories of food. So that was a 10 to 1. It was a huge plus, 10 to 1. 10 profitable calories of food for every one they burned doing that. Now, when we started gardening or hand farming, we moved away from hunter-gathering, and we started, using our hand tools, human labor. It fell to 5 to 1. It was still a plus, and so we had 5 positive, profitable calories of food for every calorie of energy we put into that. Well, our modern planting, harvesting, processing, and distribution is 1 to 10. Energy return on investment. It's not more efficient. It's consuming. We consume to get food planted and to put it on your dinner plate. It takes 10 calories of energy just to put 1 calorie of food on a dinner plate. So now these combines that have satellite tracking, the farmer no longer has to really steer. He uses a satellite that has a map of his farm, and he uses it very efficiently. So there's all this technology in that. There's all the technology of planting, harvesting, the GMO crops. Then we have to transport it to the plant. They have to process it, and then it gets transported to the supermarkets, and then millions of people every day go to the supermarkets to buy the thousands of packaged goods, and then they drive home. All that consumes so much energy. It's a huge net energy loser. So what does technology show us there? It didn't make things more efficient. It didn't really make things cheaper. What it did is it consumed our oil. Now, when we were running over 20-to-1 barrels energy return on investment, that could support that 1 to 10 energy return on investment losing agricultural system or distribution, modern agricultural processing distribution system. We could run that with shale energy only producing 5 profitable barrels, Kenneth. We can't even maintain that anymore, which is why the debt is exploding. So even though technology has brought the cost of certain things down, overall, when you factor in everything, all technology does is consume massive amounts of energy. And what you need is high energy return on investment of oil, natural gas, and coal to allow that to continue. When they fall, the whole thing falls apart. So that is the problem.
Well, definitely very interesting. Steve, I'm curious then if you, well, first of all, I want to ask you, how are they even calculating that it takes 1 calorie to produce or to get 10 calories worth of production on your plate in the hunter-gatherer phases? And then how does that really equate to the energy return on investment in terms of productivity and barrels of oil?
Okay, there's been several scientists studying this. Thomas Lau, he has passed away. He did a lot of studies in the 70s and 80s, 90s on food energy return on investment. And what they did is there were scientists studying, let's say, hunter-gatherers, and there's still hunter-gatherers in the world. There's not many of them, but they're still there. There's still a few throughout the world, very small percentage. And what they do is they calculate the energy that it takes, how much time it takes them to hunt and gather the food, and then what they acquired. And so there's been a lot of scientific data on the different aspects of food energy return on investment. And Charles Hall is one of the leading minds. He's retired now, but he's done a lot of studies with other individuals, Cutler Cleveland, they've looked, David Murphy. There's at least a half dozen or more of these individuals who take information, data, and they crunch all this information. And yes, it takes, on average, if you're going to produce corn, and you're going to grow corn, by the time you get that can of corn on your dinner plate at your home, it took 10 calories of energy to get that there. And now that only works when you have a positive energy return on investment of oil, which is above 10 to 1. You see, you have to have 10 to 1 just to maintain that. So all the complexity of our system is everything. Matter of fact, the energy return on investment is the key that allows us to either prosper or die, whether that's a person, an animal, a plant, or a corporation, or let's say the Roman Empire or the U.S. Empire. You know, when you can study the energy return on investment and you take everything, all the activity, forget dollars, forget derivatives. If you take and look at everything in energy and divide it up by the energy, then you can come up with these EROI, energy return on investment ratios. And so that's the reason why we're in serious trouble. And all this debt, all this problems that we're seeing now in the market are all stemming from the falling energy return on investment.
And of course, I mean, that links to everything, right? And I know I have some of your notes here, and it's stocks, bonds, and real estate, the falling energy return on investment, and the wealth of the elite. And that's interesting because many believe that the system is falling apart, but they don't necessarily believe that the elite are going to lose control of their wealth. But you believe that to be true in a system that falls apart. Would you care to expand on that?
Yeah, and right before I do, let me just give you a little energy data. And I looked at the top 18 U.S. oil and gas companies in the United States. The top three are ExxonMobil, Conoco, Phillips, and Chevron. Then we have a lot of shale oil and gas producers. Now, when you add up all their operating income in 2008, it was $163 billion. They made $163 billion in profit. Last year, they lost $19 billion. $19 billion when you add them up. The only one that made a profit was ExxonMobil. Now, what's interesting, their long-term debt since 2008 has almost doubled. Long-term debt, that's not a good thing. Why is your debt increasing if they're making all this money? And now here's the most interesting part. They have to pay interest on their debt. You know, if you have a credit card, you got to pay your interest payment. So everyone has to pay their interest payment. Well, their interest expense increased from $4.3 billion for these 18 companies in 2008. Now it's $6.7 billion. Last year, they lost $19 billion. They couldn't even pay their interest expense.
Wow.
So they had to either sell stock or they had to get in more debt to pay their interest expense. Now, let me just say one more interesting data point. The top three, Exxon, Chevron, and ConocoPhillips, their free cash flow, which is their operating cash minus what they paid in capital, and that's their exploration and drilling and all that, they had $46 billion in profit. That was their free cash flow in 2011. It was a minus $7 billion last year. Now, that doesn't include dividends. They're paying out a lot of dividends. In 2011, when you include the dividends, they still had $27 billion left over. Last year, in 2016, $29 billion in the hole, which is why their debt is really exploding. They had to borrow money to pay the dividends. Now, that doesn't sound like a system that's going to continue. So I wanted to give you that information. And the reason why the elite are going to suffer the most, the poor folks across the world, whether they're in South America, in India, even in the United States, wherever, they're used to being poor. And a lot of them live out in the country. Now, when the Roman Empire fell, there was 1 million people at the height of the Roman Empire. 1 million. Well, very quickly, when it collapsed, it fell down to 12,000. That's like a 99% collapse in the population of Rome.
Wow.
So those people had to leave. Now, it wasn't in the best interest of the elite at that time to see all that wealth and all the profits they were making off those 1 million people. It wasn't in their best interest for that to happen. But a lot of wealthy were wiped out. The elite were wiped out. So people moved out to the country. There's still going to be people controlling things regionally or locally. Don't get me wrong, but when this collapse happens, Kenneth, the elite are going to be gutted the most. They're going to be gutted the most. Poor people are still going to be poor. They're just going to go out in the fields and raise their own food, and it's not going to impact them as much as the elite, and that's how I see it happening in the future.
Sure. No, that makes sense. They have the most to fall, whereas the poor, they're already poor. They're closer to zero. So Steve, I want to get your thoughts on this last topic here. We're coming up on 30 minutes, and I want to touch on one more thing here. An additional unknown factor as to why Nixon dropped the gold dollar pegged in 1971. This is something you suggested we talk about. Most people know about this, but you want to talk about something that's an unknown factor as to why Nixon dropped the gold dollar peg in 1971, and I'd like to end on this topic.
Everybody knows that a lot of gold was leaving the United States and going overseas because during the Vietnam War and also the Lyndon Johnson was doing the social welfare program. So we're printing a lot of money to pay for all that. So a lot of countries said, wait a minute, gold's at $35, you're printing all this money. Oh, I got an idea. Let me just take some of these dollars and exchange it for gold. And we were shipping out, exporting lots of gold. It was lots of gold was leaving. Matter of fact, I believe it was in early 70 or early 71 that the French actually sent a battleship over to New York and to get their gold. So a lot of people think that the reason why we went off the gold dollar peg was because Nixon did not want to continue seeing the remainder of our gold being exported or shipped out. That's true. However, new information that I came across, we were going to experience a huge imbalance of gold and the gold demand and gold supply. A lot of people now are becoming more wealthy, so they were buying. There's a lot more gold being used in industry, and there was a lot more gold jewelry demand, and it was really increasing a lot. Now, this one analyst from Goldfields back in 1972 said that the gold production, which was 45 million ounces in 1972, would decline to about 38 to 40 million ounces by 1980. However, demand was going to increase to 63 million ounces from the current 45. So with the fall of supply and the huge increase in demand, there was going to be almost a 25 million ounce shortfall. So the problem was the gold market was being assaulted on two fronts. A monetary front, where the monetary debasement was seeing a lot of U.S. gold being shipped abroad to foreign countries. Also, there wasn't going to be enough gold to supply the market. And, you know, Kenneth, this is what's interesting. The same thing happened in 1965. The reason why we went off to silver in our coins is because JFK actually saw this. We just didn't have enough silver to do everything. We just didn't have enough silver to supply because, you see, technology was starting to be advanced. And they said, well, we'll just go to more a fiat monetary system. Now, there's a lot we can talk about that. Yes, silver and gold, the prices could have been higher. They could have still been money. But let's just forget that. There was just way too much silver being used in industry, and there was also going to be way too much gold used in jewelry and industry. So they decided to take gold off of the dollar peg, not only because of the monetary issue, because there was just way too much supply, way too much demand, forecasted demand. So I found this to be really interesting because no one else has really pointed that before. And so what happened was a lot of gold was dumped into the market. We know during the London gold pool, I think 75 million ounces of central bank gold was dumped into the market to suppress the price. Then Nixon dropped the gold dollar peg, and then we saw more gold being dumped into the market by the the Fed and the central banks. And then when the price kept going up, the IMF announced in 1975 that they were going to dump 1/6 of their gold. And when they announced that in August, I think it was August of 1975, the price of gold fell 20% in 1 month. But it continued higher regardless. So these were attempts to try and hold back the price of gold and silver, but the reason why the gold and silver price increased during the 1970s actually had more to do with the price of oil increasing, because from 1971, Kenneth, to 1980, gold increased 15 times, silver increased 16 times, and oil increased 15 times. They all went up because of the inflation of oil, because oil runs everything. It was the oil inflation. However, going forward now, and I'll conclude by saying this, the reason I won't think that we'll see nationalization of silver. They can get the silver in the big bank vaults. They don't need to go American person to person, and they're not going to pay $2 an ounce for it. They'll pay market value if they do that, because the market price of silver is based upon the cost of production. Same with gold. However, in the future, during this energy collapse, we have to remember bonds and stocks and even real estate are based on what is known as net present value. They get a value because of future earnings. Future earnings are based upon good economic activity. But if we have falling energy production, which we are going to, the whole oil market is going to start it's going to start disintegrate. Then the valuations of stocks, bonds, and real estate are going to fall. They're going to implode. And that's why I see the best assets to own are physical gold and silver as stores of value. I'm not talking about owning land and food and guns and all that. Yeah, those are smart to own. But the best store of wealth in the future to me will be the precious metals. They will rise in value as investors flee these huge declining paper assets. So that's my forecast for the future.
Well, powerful words there from Steve St. Angelo. Steve, thanks for coming on the line with me. I really appreciate your time, and thanks for clearing up some interesting discussions here.
No, and I appreciate it, and there's so much to talk about. I wanted to say one last thing. You know, I just posted an article. The U.S. retirement market, I think, is in trouble. I mentioned the pension plans. The U.S. retirement market, the 401ks mostly, we've been seeing net contributions increase over the last 40 years. However, in 2013 and 2014, there are more withdrawals. I think, according to my data, in 2014, which was the last data point, Americans contributed about $374 billion to their defined pension plans, or their defined contribution plans. Most of it was 401ks. But there was $402 billion withdrawn, which is like a $27 billion net withdrawal. And there was, I think, about $12 billion in 2013. I think this is going to continue to get worse. So we're seeing net withdrawals now. We're not seeing contributions. So this is another sign that the U.S. retirement market is in big trouble. So I wanted to conclude with that.